Hello traders, and welcome back to our Babypips course. For today we are already on course 8, Undergraduate, Sophomore, and today we're about to begin with using equities to trade Forex. So let's go into that. 8.3, using equities to trade Forex, and under this topic we have subtopics like Forex and global equity markets, the relationship between stocks and Forex, how the stock market affects the Forex market, how to use Euro JPY as a leading indicator for stocks, intermarket analysis sheet. Okay, so that's 8.3 subheadings for you. And so let's dive right into the very first one, Forex and global equity markets. And so we always have a tradition, so let's roll the intro to begin. So roll the intro, buddy. So here we are on Forex and global equity markets. Now, did you know that the equity market can also be used to help gauge currency movements? Now, the equity market, we're talking about, stocks and indices. Okay, you can equally use equity indices as a kind of Forex market crystal ball, okay, to know the direction of the market. There are a lot of knowledge from radio, TV, financial institutions and all that. So how can we be able to use all this information, especially from the equity market, to gauge the direction of the market? So one thing to remember is that in order to purchase stocks from a particular country, you must have to first have the local currency of that country. So let's say, suppose you want to invest in Japan, a European investor must first have have his euros and then convert those into Japanese yen. Now this increases the demand for the Japanese yen and it causes the value to appreciate. On the other hand, if he's selling the euros, that increases the supply of the euros, which drives the value of the euros down. On the other hand, when you want to use the stock market, okay, now let's say stock market is struggling, international investors take their money out of the country where that stock is, okay, and move it out elsewhere to a safe haven. And so even though you may trade stocks as a forex trader, you should still pay attention, okay, to the stock markets. So if you don't trade stocks, pay attention to what happens to stocks. So let's say you're trading the Euro JPY. Now in the stock market, if Euro JPY, people are moving money from Europe, okay, what will happen to the whole of the Eurozone, the Euro currency? The value of the Euro currency will drop down, okay, and it will affect you over here that is trading Forex, even though you're not trading stocks. So that's what we're trying to establish here, or what Babypips is saying. It says, even though you may not trade stocks, as a forex trader, you should pay attention to the stock market in major countries. It is very, very important. A strong stock market equals a strong currency. A weak stock market equals a weak currency. So if you bought the currency from the country with which if you bought the currency from the country with the stronger stock market and sold the currency from the country with a weaker stock market, you can potentially make some nice, profit. Now, that's not too familiar to understand with regards to what happens to global equity indices. Okay, so here are the major equity indices globally that you can use to gauge what is happening to a particular currency. So the Dow Jones Industrial Average, okay, is considered one of the premier stock indexes in the US. It measures how well the top 30 publicly owned companies are trading. Despite the name, any of the companies here, they are not involved in the industrial production, and instead they represent the biggest companies in America. Okay, so it is closely watched by investors around the world and is highly indicative of market sentiment, thus making it sensitive to both local and foreign economic political events. The companies that are part of the Dow are so large that you should probably deal with at least one of them. Okay, you deal with at least one of them every day: Apple, McDonald's, Disney, Nike, and the rest of them. So next, another indices you should pay attention to is the S&P 500, Standard and Poor 500. Okay, they are the comprise of stock prices of the 500 largest American companies. Okay, so you can imagine if the S&P, if 500 American companies, if their stock or their worth or the value, if it's going up, what will happen to the US dollar? Since they are in the United States, the value of the US dollar will also go up. However, if these companies, they are not doing well, if they are dropping in prices, okay, what will happen to the US dollar? It will drop because in the US. So that's basically the idea on how to use indices or equity market to gauge the direction of the price or price movement. Now the next one you can take a look at is NASDAQ. NASDAQ stands for the National Association of Securities Dealers Automated Quotations. It refers to the largest electronic screen-based equity securities trading market in the US, comprising approximately of 3,700 companies and corporations. It also boasts of having the largest trading volume among the world stock market. So that's the NASDAQ. Now, similar to the NASDAQ is the Nikkei. The Nikkei is similar to the Dow Jones Industrial Average as well. It is almost a widely quoted average of the Japanese stock market. It is a price-weighted average of the top 225 companies, and it's supposed to be reflective of the overall market. The Nikkei includes companies like Toyota, Japan Airlines, and Fujifilm. Next is DAX. The DAX is a short form of Deutscher Aktien Index. Okay, often called DAX. It is a stock market index in Germany that consists of the top 30 blue chip companies that are traded on the Frankfurt Stock Exchange. Now, with Germany being the largest economy in the Eurozone, the DAX is normally the most closely watched index within the whole of Eurozone. So some companies that are part of the DAX are Adidas, BMW, and Deutsche Bank. Next is DJ Eurostoxx 50. Now the Dow Jones Eurostoxx 50 index is the Eurozone's leading blue chip index. It comprises of over 50 top sector stocks from 12 Eurozone countries. It was created by the Stocks Limited, which is a joint venture of Deutsche Börse AG, Dow Jones and Company, and 6 exchanges. The next equity market you can look at is the FTSE, pronounced FTSE. Now this FTSE tracks the performance of the most highly capitalized UK companies listed on the London Stock Exchange. Now there are several versions of the index, such as the FTSE 100 or FTSE 250, depending on the number of companies included in the index. Lastly, you have the Hang Seng. The Hang Seng index is a stock market index in Hong Kong. By recording and monitoring the daily price changes of the stocks included in this index, it tracks the overall performance of the Hong Kong stock market. This index is currently compiled by the HSI Services Limited, which is a subsidiary of Hang Seng Bank. Now, this is all we are learning here from this section, Forex and Global Equity Market. So these are the equity market we can use to gauge the forex market. So let's move to the next lesson that talks about the relationship between stocks and forex. So here we are with the relationship between stocks and forex. One issue with global equity markets to markets. So one issue with global equity markets to make forex trading decisions is figuring out which leads which. Okay, so which comes before which one? Is it the chicken or the chick? Okay, so basically the theory behind this is that when the equity market rises, confidence in that specific country grows as well, leading to an overall inflow of funds from foreign investors. So let's say if the equity market of Hong Kong is rising, investors will put money in Hong Kong. If the equity market of Nikkei, which is Japan, is rising, investors from Europe and other parts of the world, we push money into the country, and once those companies are doing well, right, it will affect the currency of that particular country. If you understand this simple idea, then that's all you need to understand, or all you need to know, or all we need to know. So we really don't need to read all this. So, but let's just take this. It says that doesn't mean that the relationship is useless, because what does that mean? The prices of the stock, okay, of the stock market does not directly move the same way with the prices of the forex market. In fact, as shown below here in this diagram, over the last 20 years, they have moved together, moved in opposite direction, and have been unrelated. Okay, so at the time they will move together, at other times in opposite direction, and at other times unrelated. So you just have to have the basic idea in your mind, knowing that this is what is happening and all that. Now, with that also, you also have to know that when the correlation is working, whether negative or positive, and when it's not, you still have to use that knowledge to yourself. Okay. Now let's look at an example of the US stock exchange and Japanese stocks as well. They moved in opposite directions of their currencies. Any orbit economic figures in the US and Japan are more than not way down on their respective currencies, okay, the dollar and the yen. So first, let's take a look at the correlation between the Dow Jones Industrial Average and the Nikkei to see how stock markets all over the globe perform relative to each other. So let's see. Open. Oh my goodness. Okay, so it's coming. So the red line you're seeing is the Nikkei, okay, in Japan, and the blue line you're seeing is the Dow Jones. Now look at how it's moving. Okay, it's almost not going in the same direction. Okay, sometimes it's almost flowed in the same direction. At other times it went the opposite side. So use this however you want to use it, okay, but know that you can use the stock market to gauge price movement of the forex market. Let's move to the next lesson, how the stock market affects the forex market. So how the stock market affects the forex market, let's just read a little bit. A stock market index is simply a curated basket of certain stocks. This list of stocks is a way to get a broad measure of what's happening in the stock market. Okay, now let's discuss two of them. The very first one, the Nikkei 225, commonly known as the Nikkei, is the index of stock average of Japan stocks market, comprising a list of 225 companies listed in Tokyo Stock Exchange. Now the Dow Jones, simply the Dow, is a US stock market index that measures 30 large American companies listed on the New York Stock Exchange and Nasdaq. So now let's just look at this diagram. If as by this time you don't understand what I was saying, I think you should just skip this. Sometimes, okay, they move unrelated. At other times they move relatedly. That's just it. Okay, so if the stock market, let's say the Dow and the Nikkei, if they are going in the same way, okay, then fine, you can hop into USDJPY. Okay, if the Dow is going up and the Nikkei is going up, hop onto USDJPY, okay, and see what is happening right there. Like in this scenario, you can see that they are moving side by side. Okay, the USD, the Nikkei, the blue line is going down, the USDJPY is going down. So when you go to your forex chart, what do? You just hit sells. So use this to the best of your advantage. Okay, and look at other times. This is directly on the opposite side. They are not moving correlatedly at all. They're moving in the opposite direction. So use that to gauge, use the correlations to gauge how you trade your forex market as well. Okay, so the next lesson we are going to learn is how to use the EuroJPY as a leading indicator for stocks. So let's discuss this really quick. how to use the EUR/JPY as a leading indicator for stocks. Now, it is the same thing we have been saying for a long time. If the EUR/JPY, okay, if it is climbing, that shows that the stock of that particular country is also doing well. So investors are investing in the Eurozone. Now, if the EUR/JPY is falling, okay, if the EUR/JPY falls, as traders run for cover because the economy, I mean the Eurozone is not doing well, what will happen? Investors will move their money from Europe rather, and put it on the other side. The money will be safe. And so what will happen? They might move the money from Europe and put it in the United States, or so that is how you should use the EUR/JPY to gauge investing in stocks. Okay, so we're not talking about stocks here. So let's move to the next lesson that talks about intermarket analysis cheat sheets. As you can see, I'm really going really fast, not really reading all this because many of all these don't really concern or matter to us that much. So what is this cheat sheet all about? Now, intermarket analysis studies the relationship between asset classes, typically currency, bonds, commodities, and stocks. It can help traders generate a broader trading ideas, reveal potential market turning points, or confirm other analysis methods. Now, the price action of currencies is often driven by their relationship with commodities, bonds, and stock indices. For example, a falling US dollar is viewed as positive for commodity prices, while a rising US dollar is considered negative for commodity prices. Falling bond prices or rising interest rates tend to be negative for stocks, while rising bonds or prices falling interest rates are normally good for stocks. Now, rising commodity prices are historically a sign of economic growth, which is good for the stock market and negative for the bond. That's a lot, right? So if you really want to use this or you don't understand what we just did, come back to it and listen. We'll try to close this complete this course as soon as possible. So here is the cheat sheet. If gold is rising, then the US dollar is going to come down. Why? Because during times of economic unrest, investors tend to dump the dollar in favor of the gold. Unlike other assets, their gold maintains its intrinsic value. Okay. Now, if gold is rising, the Australian dollar is rising. Why? Because Australia is the third biggest gold producer in the world, selling out about 5 billion watts a year. Now, if gold is rising, the New Zealand dollar is also rising because it's also a large producer of gold. Now, if gold is rising, USD CHF is dumping because over 25% of Switzerland reserves are backed by gold. So USD is dumping, CHF is rising in this regard. If gold is rising, the USD card is coming down because Canada is the fifth largest producer of gold in the world. As the gold price goes up, the pair tends to move down. Canada is bought. Now, if oil is rising, USD card is dumping. Canada is the top fifth oil producer in the world. They export about 5.5 million barrels of oil a day to the US. Now, if gold is rising, the Euro USD is rising. Why? Because both gold and Euro are considered anti-dollar. So if the price of gold goes up, Euro USD may go down as well. Now, bond yields. So in bond yields, your local currency also yields. So an economy that offers high returns on its bonds attracts more investors. This makes its local currency more attractive than that of another economy offering low returns on its bond. Now, if the Dow Jones is down, the Nikkei is down. So if the US dollar is going down, the JPY also is down. Why? Because the performance of the US economy is closely tied to Japan. Now, if the Nikkei is down, the USJPY is also down. That's because investors consider the yen as a safe haven and tend to seek it during periods of economic distress. So that is all we'll be taking for this section. This is the cheat sheet. If you would like, you can print this out, or you can write it out and paste it somewhere close to you and always refer to it. So we'll have one more lesson to go before we complete undergraduate sophomore. So with that, I want you to share this video with your friends. If you haven't already, smash the like button or like button and tell me what I need to do to improve on this video. I really appreciate it. And yeah, one more time, smash the like button, subscribe if you haven't, and until next time, I wish you success.